Failed variable rate mortgage experiment is dead. Bank of Canada and OSFI weigh in. In a landscape where mortgage financing is a critical aspect of homeownership, there's a brewing storm in Canada's housing market. Recent statements from the Bank of Canada's Senior Deputy Governor, Carolyn, and the Office of the Superintendent of Financial Institutions, OSFI, have raised significant concerns about certain types of mortgage products, particularly fixed-payment variable-rate mortgages and negative amortization mortgages. These concerns are not merely whispers in the financial corridors, they are echoing loudly. In this video, we'll explore the possibility that the Canadian government, in collaboration with banking regulators and encouragement from the Bank of Canada, might take measures to reduce or even end the practice of variable-rate mortgages. These types of mortgage are increasingly seen as highly risky for Canadian homeowners and mortgage borrowers. We'll draw insights from two compelling articles in order to shed light on this emerging narrative. The first article is published by Canadian Mortgage Trends titled, "Fixed Payment Variable Rate Mortgages, a Dangerous Product," says OSFI. The other article is by Bloomberg News and published on the Financial Post website titled, "Bank of Canada's Carolyn urges close look at negative amortization mortgages." These pieces shed light on the concerns raised by the Bank of Canada's Senior Deputy Governor, Carolyn, and the regulatory perspectives of the Office of the Superintendent of Financial Institutions, OSFI. The concerns presented may shape the fate of variable-rate mortgages for Canadian homeowners. Fixed payment variable rate mortgages, a dangerous product, says OSFI. In a November 2, 2023 article by Steve Huebl, published by Canadian Mortgage Trends, the Office of the Superintendent of Financial Institutions, OSFI, Canada's banking regulator, expressed concerns about fixed payment variable rate mortgages, referring to them as a dangerous product that increases the risk of default for certain borrowers. Peter Routledge, head of OSFI, made these remarks during his testimony before the Standing Senate Committee on Banking, Commerce, and the Economy. These mortgage products, offered by most major banks in Canada, maintain fixed monthly payments even as interest rates fluctuate. When interest rates rise, a larger portion of the monthly payment goes toward interest costs, increasing the borrower's mortgage balance. OSFI estimated that $369 billion worth of outstanding mortgages in Canada, out of a total mortgage market of $2.1 trillion, are fixed payment variable rate products. Approximately $260 billion of these mortgages have extended amortization periods of 35 years or longer. OSFI had previously voiced concerns about these mortgages and expressed a preference for their reduced prevalence in the market. The article also notes that experts have pointed out how these mortgage products have provided a buffer for variable-rate mortgage borrowers against the full impacts of interest rate hikes by the Bank of Canada. However, borrowers using these products may face payment shocks at renewal, similar to those with fixed-rate mortgages, and potentially more significant if their mortgages had been negatively amortizing. Peter Routledge also commented on the results of OSFI's public consultation on proposed mortgage underwriting changes. The regulator confirmed that it would no longer pursue certain proposals, such as debt-to-income (DTI) restrictions, while keeping loan-to-income (LTI) restrictions under consideration. The decision was influenced by the feedback from stakeholders, which indicated that the current mortgage stress test was deemed sufficient due to the relative stability of the housing market and low credit losses. While OSFI is not rushing to change the mortgage stress test, Routledge mentioned that the regulator remains open to considering more targeted protections. OSFI supervises banks on an individual basis and has the flexibility to explore additional safeguards for the mortgage market. Bank of Canada's Carolyn urges close look at negative amortization mortgages. In a recent article published on November 3, 2023, by Bloomberg News, Carolyn, the Senior Deputy Governor of the Bank of Canada, raised concerns about a particular type of mortgage product known as negative amortization mortgages. These concerns have ignited a discussion about the implications and potential risks associated with this mortgage structure. and its impact on borrowers and the Canadian housing market. Negative amortization mortgages are gaining attention due to the way they operate. They allow borrowers to make fixed monthly payments even as interest rates rise. This might initially seem advantageous as it reduces the immediate financial shock of higher borrowing costs. However, the downside is that the length of time required to pay off the mortgage, known as the amortization period, is significantly extended. This means that borrowers may spend years, or even decades, paying down very little, if any, of the principal amount of their mortgage. What has raised alarm bells is the rapid proliferation of these types of mortgages in Canada, leading to over $200 billion in mortgages with exceedingly long amortization periods. In this scenario, many borrowers are essentially covering only the interest on their loans, leaving the principal amount nearly untouched. This situation is concerning on multiple fronts and warrants closer examination by financial institutions, regulators, and industry stakeholders. Senior Deputy Governor Carolyn Rogers expressed her unease with this type of financial product. During an interview with Bloomberg News, she highlighted the pressing need for scrutiny and regulation in this area. Her comments emerged following a meeting with senior bank executives in Toronto, where the topic was presumably discussed extensively. Rogers remarked, "I think that product needs a close look. And I think it'll get a close look." She further suggested that the industry would reflect on whether they should continue offering this mortgage product. She emphasized the collective concern regarding the substantial presence of negative amortization mortgages in Canada, stating, "It is concerning. You don't want a big portfolio of negative amortizing mortgages. It's not good for the banks. And it's not good for the mortgage holders." Rogers indicated that there seems to be an industry-wide effort to address these concerns before borrowers reach the renewal dates of these loans. The urgency lies in the potential risks and challenges that both lenders and borrowers could face if these issues are left unaddressed. It's worth noting that it is unusual for a senior official from the Bank of Canada to comment on a specific financial product in such a manner. Regulatory oversight of financial institutions in Canada typically falls within the purview of the Office of the Superintendent of Financial Institutions, OSFI. Interestingly, Carolyn Rogers spent a substantial part of her career in financial regulation at OSFI before joining the Bank of Canada nearly 2 years ago. Her background and expertise in the field make her insights and concerns regarding negative amortization mortgages all the more significant. In this article, Carolyn Rogers expressed concerns over the rise of negative amortization mortgages in Canada highlight a growing issue in the Canadian housing market. While these mortgages might provide temporary relief from higher interest rates, they also present the risk of long-term debt accumulation, affecting both financial institutions and borrowers. As this topic garners more attention, it is expected that discussions, debates, and potential regulatory actions will continue to unfold. This concern voiced by a senior Bank of Canada official underscores the importance of addressing the potential risks associated with certain mortgage products in the evolving landscape of Canadian housing finance. As we conclude this discussion, it's clear that the landscape of mortgage financing in Canada is evolving, and important questions are being raised about the safety and sustainability of certain mortgage products. The concerns expressed by the Bank of Canada and regulatory authorities underscore the need for a closer look at these financial instruments. While it's uncertain what the future holds for variable rate mortgages, it's evident that these government institutions believe that they are risky enough to re-examine their long-term viability. What do you think? Are variable rate mortgages a useful financial instrument which help mortgage borrowers? Or are they too risky and pose a danger to unsuspecting homeowners and the Canadian economy and financial system as a whole? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.